Well, I think that the market is flying blind at this point because it's waiting for second quarter earnings to be reported. There is an absolute lack of guidance. And at the same time, Wall Street is making projections as to how the rest of the year and 2021 are likely to go. Technology continues to lead the pack, primarily because it ends up being a winner if we have an expanding economy, but also a winner if we go back into some sort of a shutdown because of the coronavirus. Add to that very, very low interest rates, which tend to support growth for the more cyclical side of the equation. And those factors together are causing investors to continue to jump on the tech bandwagon. Everybody needs technology, especially if they're working from home, in terms of broadband, in terms of hardware, in terms of Zoom communications. So there are a variety of things that are tech related that are important. If the economy expands, well, then companies will need to be adding to their technology. And at the same time, traditionally, when interest rates are low, growth stocks tend to do better than value stocks because of the discounting of future cash flows. So the momentum is still with the tech sector, and until that momentum, that mindset changes, technology will continue to advance. Also, it's not stretched from a valuations perspective as it was back in 2000. The S&P 500 tech sector is actually trading at a double-digit discount to its relative PE average over the last 20 years. The expectations are for a more than 45% decline in S&P 500 earnings. The last time that we saw an even worse performance was the fourth quarter of 2008. We're expecting consumer discretionary and energy stocks to post outright losses, not just year-on-year declines. But every single sector within the S&P 500 is expected to post a year-on-year decline, and only about 10% of the sub-industries are expected to post increases. The banks are the first ones to come up and report their earnings. They too are expected to be deeply in the red. But I don't think that just because how deep the earnings expectations are will cause the market to go down any further, because these numbers have already been factored into share prices. As a result, I think investors are saying the only way you can surprise me is if your earnings come in better than expected, not worse than expected. What I worry about, first off, is valuations. We're looking at an S&P 500 that is trading at a more than 50% premium to its own price to earnings ratio average over the last 20 years. Also, I look at the best performing sectors versus the worst performing sector, and usually when that differential is very wide, then the market does not do very well in the period ahead. And right now, we are within the top quintile in terms of how wide the difference between tech and energy, the best and the worst performing sectors, has been. With that in mind, I would not be telling people to be adding aggressively to their portfolio right now. I would not be advising them to be chasing the market, that I think the market is becoming more vulnerable to a digestion of gains. We are in the most challenging 6 months of the year, the most challenging quarter of the year, and typically August and September are the two worst months of the year. July tends to be surprising for investors, and typically we have a delay of displeasure, if you will. So usually the market goes up in July only to then tank in August and or September.